This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the final lecture on chapter 8 of the free lecture notes, where I need to say a bit more about inflation. Now, in the last lecture, we had a question with inflation, and we inflated the cash flows to get the actual or nominal cash flows. We discounted the actual or nominal cost of capital. And certainly in section C, long form questions, almost always that's what we'll do. In fact, whatever's coming in this lecture, I'll explain why, but there'll be no alternative usually. However, and particularly for the short multiple choice questions, what I'm about to explain in this lecture certainly could be relevant. I'll be quite specific at the end how to know whether it's relevant or not. Because the point is that in theory, certainly, the cost of capital, the interest we're having to pay, will go up and down with the rate of inflation. And the two, in real life, it's true to an extent. I don't care which causes the other. But as we got higher inflation, we tend to have higher interest rates. With lower inflation, lower interest rates. And so as I'm going to illustrate to you, the alternative approach will be to discount the cash flows ignoring inflation at the cost of capital if there was no inflation. The two do go up and down together, you see. So if there's no inflation, I'm making up figures as always here. If there's no inflation, maybe the cost of capital would be 10%. But as inflation goes higher, you know, if inflation was 5%, you'd expect the cost of capital to be higher as well. In fact, I'll show you why later, but it would, in theory, to be 15.5%. But the point is, the two go up and down together. And so, again, as I'm about to illustrate, as an alternative to inflating the cash flows and discounting at a higher cost of capital, we get the same result by ignoring inflation on the cash flows and discounting at the cost of capital if there was no inflation. Now, I keep saying I'm about to illustrate it. Before I do, another word for the cash flows without inflation are the real cash flows, which can be a bit confusing. I mean, it doesn't mean this is what the actual cash will be. Obviously, the actual cash will be higher because of inflation. But the cash flows ignoring inflation, we call the real cash flows. The cost of capital, if no inflation, we call the real cost of capital. Now, let me illustrate exactly what I mean, and then, quite importantly, I'll tell you when this will be, what sort of question this will be relevant in. Look at example 6. A machine will cost 120, is expected to last 3 years with no scrap value. Production will be 10,000 units a year. The selling price is 20 a unit, the variable production costs 14 a unit, both quoted in current prices. Inflation is expected to be 5%, and the cost of capital is 15.5%. And we're going to calculate the NPV, but I'm going to do it two ways, just to explain to you what I was saying. It's a very short one, but deliberately just to explain the principle, and then, I've said twice already, I'll tell you how this could be tested on, what it is you need to learn. But first of all, let's do this question the way I did in the last lecture, the normal way. Let's work out the nominal, the actual cash flows, and discount the nominal actual cost of capital. So we've got a cost of 120,000. Actually, I'll set it up the way I should be doing. 0, 1. How many years is it? 3 years. The operating cash flows. Well, the selling price is 20, the variable cost is 14. But since they're both inflating at 5%, although I could show the two separately, why not put the two together? That the net flow at current prices, selling price 20 minus 14 is 6. It's 10,000 units a year, and I'll work in thousands. So the first year, I'm working thousands, so 10,000 times a net $6. But that was at current prices. With inflation at 5%, the flow in the first year will be 60 times 1.05, 63. First. In the second year, multiplied by another 1.05, and we get 66. In the third year, another 1.05, we get 69. So I'm to the nearest thousand. There's some rounding problems here ultimately, but I don't care. So there are the nominal, the actual cash flows. We've got an initial cost of 120 times 0. There's no other cash flows, so I don't need to put the totals in. We'll discount at 15%. So the discount factors for 1 year, 0.870. For 2 years, 0.756, and for 3 years, 0.658. So the NPVs, the present values, wrong with me, 63 times 0.87. 66 times 0.756. 69 times 0.658. Can't be right. Yes, it can. All right, so the NPV . 30, we'd accept. So that's doing it the way we did in the last lecture, and that is, as I have said, for section C, that is almost always the way we would be doing it in the investment appraisal question. We've got the nominal cash flows. The cost of capital is always the nominal cost of capital, unless you're told differently. We've discounted nominal cash flows and nominal cost of capital. However, I said we could instead have ignored inflation completely, discounted the cash flows without inflation, or whatever the cost of capital would be without inflation. And there is a formula to take the inflation out of the cost of capital. It's the Fischer Formula. It's given on the formula sheet, and I've typed it above the example. That the only trouble is the symbols, so I'm afraid you have to learn the symbols. But 1 plus I, where I is the actual cost of capital, is equal to 1 plus R, where R is the real cost of capital without inflation, times 1 plus H, where H is the inflation rate. And so what have we got here? The actual cost of capital is 15%. So 1 plus I is 1.15 is equal to 1 plus the real cost of capital times 1 plus H, the rate of inflation. And the rate of inflation here is 5%, 1.05. And so 1 plus R is 1.15 divided by 1.05, which is 1.0952, or R is 0.0952, or 9.52%. So we're saying that had there been no inflation, the cost of capital would be 9.5%. But as you've got inflation, the cost of capital will be higher. And again here, when inflation is 5%, the cost of capital is 15%. They go up and down together. And so our alternative approach is to ignore inflation completely and to say, okay, without inflation, the operating flows, well, at current prices, it's selling price 20, variable cost 14, so it's 6 a unit, 10,000 units. So if we ignore inflation, it's 60 each year. The cost, of course, isn't affected, 120. And if we now discount at 9.52, now incidentally, you would never be required to discount at a funny rate like this. You've got tables. I'm only going to do it here at 9.52 to prove to you that it's the same net effect. Because you do know, again, from the earlier lectures, that the discount factor is 1 over 1 plus R. For 2 years, 1 over 1 plus R squared. For 3 years cubed. But I say again, don't panic. You won't be asked to discount at funny rates. I'm only doing it here, as I said, to prove to you that it sort of works. So what are the present values? 60 divided by 1.0952, 55 divided by another 1.0952, 50 divided by another 1.052, 48. And are those the same figures I got before? Not quite, but that's rounding. I'm not worried about a bit of rounding. Obviously, I've done it to only 3 decimal places. And the NPV, apart from rounding, will be exactly the same. So that's what's happening. You know, for the last time, if they want 9.5 without inflation, as we have more inflation, the actual cash flows will be higher. But with more inflation, the nominal cost of capital will be higher. The two go up and down together. Now that's beautiful. But it only worked here because everything was inflating at the same general rate of inflation. If you think back to the previous example, we had labour inflating at one rate, 5%, materials at 8%, the selling price at 7%. Well, the cost of capital can't go up and down with all sorts of different rates of inflation. The cost of capital goes up and down with the general rate of inflation. And we couldn't have used this approach in the previous example. We couldn't. And so I did say, and this is important, the times this is relevant in the exam three situations. The first, obviously, is if the question tells you to discount at the real rate. If you're told to do it, you do it and you don't argue, clearly. Unlikely, it happened once, but it's unlikely. Secondly, the one time you have no choice but to use this method is if it's a perpetuity. And this would only be relevant in the short 2-mark questions. But let me explain what I mean. Suppose I told you there was a receipt of 10,000 per year at current prices. In perpetuity. Suppose I told you there's inflation at 5% per annum. Actually, I changed it, we had 5 last time, so that's of a different rate. 4% per annum. And the actual or nominal cost of capital is 12%. Well, think about it. You couldn't use the approach we took in example 5 on this one. You know, you can't get the actual cash flows if it's in perpetuity. You're going to be there forever. You know, in 1 year's time, 10,000 times 1.04. In 2 years' time, 10,000 times 1.04 squared. In 3 years' time, you can't go on for perpetuity. You can add it in. If it's a perpetuity, you've no choice. You'd have to use that formula and say, well, the real rate, 1 plus r, is equal to the nominal rate, 1.12, over the inflation rate, 1.04. Sorry, 1.12 divided by 1.04 is 1.076923, or r equals 7.6923%. And although I had said earlier, you'll never be required to discount at funny rates in the exam, the one exception is a perpetuity. Because remember, a perpetuity, we don't use tables at all. The discount factor is 1 over r. So what have we got here? At current prices, 10,000 per annum. With no choice but to take the real cash flows and discount at the real cost of capital. Well, the factor 1 over r, the real cost of capital, 0.076923, giving a present value of £130,000. So I have one more thing to say for relevance to the exam, but in a section C long form question, almost without doubt, if there's inflation, it'll be like example 5 rather, nominal actual cash flows discounted at nominal actual cost of capital. The one time you're forced to use this approach is when it's a perpetuity. The only time you're forced to use it, which would be in the 2-mark questions. However, I said there were 3 relevances to the exam. If you're told to use real rate, obviously do what you're told. I've said enough about perpetuity, you've no choice. But the third situation and again this has happened, where it's just like example 5, where you've got different rates of inflation, so you calculate the actual or nominal cash flows you want to discount at the nominal actual cost of capital, but the question says real cost of capital (10%) general inflation rate . 3%. Now, don't let me confuse, make sure you understand me. Suppose you were given an example just like example 5, the one in the previous lecture, where you have lots of cash flows all inflating at different rates. Fine. You calculate the actual nominal cash flows, you inflate them all just the way we did in example 5. You want to discount the actual cost of capital, and I said, unless you're told differently, the cost of capital you're given is the actual cost of capital, and you simply discount. But if he does say, oh, the real cost of capital is 10 and the general inflation rate is 3, well, you need to calculate the actual cost of capital, and you'll use the formula. 1 plus the actual cost of capital is 1 plus the real cost of capital times 1 plus the general inflation rate. (1.133). The real cost would be 0.133 or 13.3%. Strictly, you discount at 13.3% the actual cash flows. In these, when it's a 4 or 5 year project, he will always be expecting you to use tables. He won't expect you to discount at 13.3. In fact, when he's done this, he's chosen rates that end up giving him, a perfect number, 15%, 14%. Something. If you did get 13.3, then you would approximate. You'd use the tables and discount at 13%. So I do hope that's clear. In long form questions, it's always the way we did in the last lecture, example 5, unless A, you're told specifically to do different, or still like example 5, but you have to calculate the actual cost of capital. In the short 2 mark questions, if it's a perpetuity, you've no choice. You have to do it this way because you can't do it the other way. Okay, so that's it for inflation. That's it for all the little techniques involved in a normal full NPV question. The next chapter says further aspects. It's because there are 3 special situations that he does ask from time to time, 3 completely separate special situations, which, well, I'll explain what they are. It's not the discounting that changes, it's just the approach has to change. But anyway, I think you'll enjoy it. It's quite straightforward. We'll do that in the next set of lectures.